Welcome to another episode of Rich Dad StockCast, where we help those that are serious about improving their financial education. I'm your host, Denney, and today's topic is one that can help you navigate and even profit in challenging markets. Short selling, how to profit when the market falls. Now, before we dive in, remember to like, subscribe, and leave your comments below. Your feedback helps us to bring you more of the content that you want to hear. And also, don't forget to visit StockCastBonus.com for free access to valuable educational resources to boost your financial knowledge. Now, joining us today is none other than Rich Dad expert Andy Tanner. Andy, welcome back to the show.
Oh, it's great to be with you, Dell. I am stoked. You've just been crushing the topics. The things you bring up for discussion are so central and foundational and empowering. So I'm excited to share a little bit about this topic because I make a lot of money this way. I mean, this is a huge deal for me. And if other people can learn that concept, I make the money in a very surprising way with short positions.
All right. So short positions, people may not know what short selling is. You know, short selling is a strategy that allows investors to profit when the stock prices fall. It's powerful, but it comes with risks that every investor should know. Andy, can you explain the concepts of short selling, how it works, and the risks that are involved with it?
Yeah, let's make some distinctions between what it is and what it isn't specifically. So, sometimes someone will say, do you have a tissue? And other people say, well, do you have a Kleenex? Right? And they're kind of the same thing. You want to make sure that we're going to speak about this in a technical way, not so much a broad way. So, when someone says I'm short the market, a lot of people confuse that with saying, well, I'm making money doing, on something that's going down. And that's very much true. But I can be bearish and have bearish positions without going short. So let's make sure that distinction's there. I could buy a put and be long a put and make money when the market falls. I could buy a call on the volatility index and be long a call, long, not short, and I could absolutely crush it in a crash. So a bearish position is not always synonymous with shorting. The other thing a person, if they want to really get good at this, is don't get caught up in buying and selling. Actually think about it as an exchange. When you go to the Chicago, we have the Chicago Board of Options Exchange. When you go to Wall Street, down New York, you have the New York Stock Exchange. And that word exchange is really important. For example, if I buy gold, did I buy gold or did I sell my cash? If I buy real estate, did I buy a house or did I sell my cash? Or would it be more proper to say, look, I made an exchange. I made a trade. You got the Chicago Board of Trade, right? You have trade between China and the U.S. It's a trade issue, import and export, trade, not buying and selling necessarily. So to understand shorting, really begin with the idea of trade is a better way to think of this. And there's 4 steps to shorting, and this is a complex thing to talk about without my whiteboard, my charts and my drawings, but I'll do my best. Assuming that you at least understand what a balance sheet is. Okay, let's understand what a balance sheet is. A short sell is not going to be a cash flow issue. A short sell is going to be a balance sheet issue. We're not going to see it immediately on the income statement. We're going to start with the balance sheet. And if you were to think about an asset as it relates to your net worth, if an asset is something that you buy, and if the value of that asset climbs, your net worth climbs. Pretty simple, right? If the overall number in my asset column goes up, then my net worth goes up. Now think about this. If I have a liability, something that I borrowed, and that amount is reduced in my financial statement, in the liability column, what happens to my net worth if the liability column is getting smaller? What happens? I'll ask you, Dell. If the assets go up, my net worth goes up. If the liabilities go down, my net worth goes.
If your liabilities go down, your net worth goes up.
It goes up. Now that's illuminating. if you really think about it. Because now I have two ways to increase net worth. I could either buy something that goes up in value, or I could borrow something that falls in value. That is profound. And the reason it's profound is several reasons. Number one, to buy something, it takes money. To borrow something, it doesn't. In other words, I can borrow faster than I can earn and buy. I can always borrow faster than I can buy. Trust me. You can go into debt and borrow money on your credit card faster than you can earn money to pay for things with cash. If I said go out and go on a shopping spree, and you can either have cash to buy with or you could borrow and get stuff, borrowing would be faster. It's just an accelerator. So that's the first thing, is that I have an opportunity to borrow myself rich as opposed to buy myself rich. The second thing that is so critical is it is much easier often to see things that are going to go down in value than things that are going to go up in value. For example, years and years ago, President Obama was in a debate with Senator Romney, and they were both running for the presidency. So Mitt Romney's arguing with Obama, and they were fighting over whether or not GM should declare bankruptcy or try to be saved. And everyone in the whole room knew they were going to go bankrupt. Their financial statement was so awful, and their off-balance sheet promises, their liabilities to their union worker pensions were so large that they knew they were like the Studebaker company of the 50s. These guys are going out of business. They're going out of business. It is so much easier to see a behemoth like GM about to collapse than it is to find, out of the 5 zillion nerds in their garage, to find Steve Jobs working on a circuit board because he's too tiny. It's easier to see big things that are going to collapse than microscopic things that are about to explode. So I'll give you an example of where I make a lot of money. A lot of the money that I make from assets comes from a short position where I'm shorting the US dollar. Now, let me explain that. There's 4 steps to shorting, and we'll get into that maybe after the break. But if you want to place a bet on the price of Apple, and you're going to ask me, is it topped out? Buffett's selling all his Apple. Is it, can they innovate? How many, things can they cram into an iPhone that's going to be different, right? There's not much more they can do with this. So their challenge is innovation. So I say, is Apple going up or down in 5 years? Is it going to be higher or lower? Is there obsolescence risk? Is there somebody to take them out? Who knows? I don't think so. But I couldn't tell you, Del, I couldn't tell you with any level of confidence where Apple is going to be tomorrow in their stock price. I don't know whether it's going up. I don't know whether it's going down. Since I own some, I hope it's going up, but I don't know. That's more of a hope than a knowledge, right? That's a bet I make with a lot of risk. Okay, now let's look at this one. What do you think the chances of the dollar losing value over the next 30 years is?
Pretty
strong. If you were to place a bet, I'd say it's damn near 100%. Yeah. I would.
Yeah, I agree.
When we went off the gold standard in 71, I was 3 years old, and my grandfather was a gold bug. He owned a smelter. We had gold and toxic chemicals. That's why I'm so goofy. I was, watching molten gold all my life growing up. I mean, it was a regular occurrence for me to see gold, or more likely silver, because it was more abundant, silver in its molten form, sink to the bottom, hit that slag on the top, and reveal that shiny bar of silver. I grew up with it in my hands. So my grandfather taught me the evils of going off the gold standard, and he was so afraid of inflation. He was a German immigrant. His parents understood what happened in the Weimar Republic. He understood the hyperinflation of the German mark. He understood the devaluation of currency, and he instilled that in me as a young man to where it was just part of my being. I understood it when I was 6, 7 years old. And so the idea that the dollar is going to lose value, and I'm going to be telling my grandkids about when gas was 35 cents a gallon, and my kids are going to tell when it's $35 a gallon, and oh no, it wouldn't happen. My grandkids will talk about when gas was $3.50 a gallon, when it's 35. And I'll talk about when it's 35 cents, now it's $3.50 or whatever it is. So So the idea that the dollar is going down is a huge opportunity to take a short position. And the best way to do that is to borrow money. Now, Dave and Susie would go nuts on this. Dave Ramsey and Susie Orman would go freaking bananas on this. But I will tell you, the safest bet you could possibly make as an investor is that the dollars go down, and you should borrow as much as you can, as fast as you can. I can't be any more opposed to this abhorring debt. If you want to become wealthy, your safest bet is to borrow as much as you can, as fast as you can, intelligently, right? Not stupid, not credit card consumer debt, but proper investment debt. You can grow your money much faster this way. And it's a really nice bet because the dollar is going to lose value. So I mentioned that there were 4 steps to a short position. So maybe we go through those. Boy, you put a nickel in me the last couple episodes. I won't shut up. My goodness.
That is, I like this. I like where we're doing. But let's do this. Let's take a quick break. Let's go to the 4 steps right after break. So listeners, don't go anywhere. Stay tuned. When we come back, Andy will share the 4 steps to shorting and how to profit in a declining market and protect your portfolio. Don't go anywhere.
So far, it's been great. I needed a source where I could really enrich my education through stocks. I didn't really have an avenue for it, and it's helped me a lot. The simplicity has really gotten me on the track to where I enjoy the learning as well as it's really solidifying in my mind. And like, they're not just trying to sell you something, they really care about the people that are in the course, and they really do care about you and your personal goals, and what you want to do is to help you and your family and whatever your goals are in life through that. So it's really been great.
Welcome back to Rich Dad StockCast. I'm your host, Denney, and today we're exploring short selling. Now, before we jump back in, don't forget to visit StockCastBonus.com for free tools and resources that can help you to better understand advanced investment strategies and start building your financial knowledge. Now, Andy, let's get into the practical application of short selling. You've talked about the 4 steps. Now, let's go through those. What's step number 1? Do you want to do an overview first, or do you want to go step by step?
No, let's hop right in. Step number 1 is to borrow. Before the break, we spoke about the idea that if you have a liability and the value of that liability drops, your net worth increases, right? And it's hard for people to get their head around that because they're dogmatic. Robert Kiyosaki, I owe him so many lessons he gave me. I remember he was teaching once. He said, I have a right hand and I have a left hand. I do not have a right hand and a wrong hand. They're simply opposite, opuesto. It's just opposite. And it's not good or bad. And we look at income good, expense bad, asset good, liability bad. No, they're just opposite from one another. Buying is how you put something in the asset column. Borrowing is the opposite. You can do 2 things at a bank. You can save money or you can borrow money, right? You can buy a CD or you can borrow a mortgage. It's just opposite, and not one better than the other. What makes it good or bad is what the asset does once you bought it or borrowed it. We had to rescue with what we called the toxic assets. They had billions and billions and billions in the asset column, and they were supposed to be so good. Well, those were collateralized debt obligations, right? They were CDOs. They were mortgage-backed securities. And these were toxic. They were awful. They were the thing that was the devil, and it was an asset. And when the assets fell in value, that's where those guys got crushed. And so the Fed had to buy them out and bail them out. And they were buying assets that were toxic, not paying off their liabilities. They were taking toxic assets off their balance sheet that sucked. So you can have a bad asset called a CDO that can be like a millstone around your neck. So the first step, if you want to take a short position, is to find something that's going down in value and borrow it. That's step number 1. Something that's going down in value and borrow that item. And in my case, my favorite one to do this with is the US dollar because I feel it's going down. The second step is to trade that for something that you don't feel is going down in value. So you borrow, $1 million and you buy a building, like a house, right? and the square foot won't change, and the number of bedrooms won't change, and the number of acres won't change, you can rest assured that that's going to be consistent. So you borrow some money at a fixed rate, and you trade that money sell the money for a house. You exchange it, you trade it. That's the second step. The next step is to trade back in some way. In other words, take what you traded away and then trade it back after it's lost some value. So what you're doing is you're taking that money, you're trading it for a house, and then you trade some time and get the money back, called rent. So there's two trades. There's money for the house, and then there's time for money, and you get the money back. So money goes into a house, and then they trade time in the house back to money. So you have the money back, and then you return it. Number 4 is you return that money when it's worthless or worth less, whichever one is fine. So borrow when the money's fat and valuable, trade it for a house, right? Then get the money back and trade it over 30 years as the money's becoming worth less. So you're giving back to the bank something that is worth less than when you took it. Well, if you take the money and then you give it back when it's worth less, if you made those trades, the wealth gets trapped in your asset column. The wealth is in your asset column. It gets trapped there. And so it isn't that houses are getting more expensive. It's that the dollar can't buy as much, is a better way to think of it. The square footage is the same. The value of a house today is the same as it was 100 years ago. What you get is 4 walls of your home and a place to lay your head at night. That hasn't changed in 100 years. It's still 4 walls of your home. But the amount of money it takes to buy it has changed because the dollar's lost value. You can do the same thing with the stock. Borrow the stock if you think the stock is going down. Trade it for cash. Let the stock go down. Buy it back when it's cheap and return the stock to the brokerage. So you could do this with anything. Borrow it, trade it back, return it. Those are the 4 steps. Borrow it, trade it back, and return it. And you can do that with stocks. You can do that with cash. You can do that with currencies. You could do it with a cup of sugar from your neighbor if you wanted. If you felt sugar was going to go down, borrow the sugar from your neighbor, trade it for cash, buy it back when it's cheap, give the sugar back. It's not that complicated if you practice.
What you talked about shorting the dollar. Do you see any other sectors that seem to be going down as well? I mean, not looking for stock advice, but thinking about, like, that's a no-brainer that the dollar is going down. We're not backed by gold.
Well,
is there anything else like that that's out there?
yeah, I mean, you could short all kinds of stuff, but I think the thing to think about mostly is the risk, because the risk of shorting is higher than going long. If I borrow something, if it does go up in value, then I'm in trouble, because when I trade back, I could be in trouble. If the dollar were to strengthen, which is why we don't want depression. Real estate investors would rather have hyperinflation because it erases their debt. But if we had depression, boy, then they're in serious trouble, because now rents fall because the dollar will buy so much more time. Now home prices fall because the dollar will buy so much more square footage. So the challenge with shorting is you have an infinite potential for loss, because there's no saying how high the value of something can go. So if you borrow a stock and it doesn't go down, how high, you buy a stock for $100, you got $100 risk. You borrow a stock at $100, you have an infinite risk, because it's opposite. It can go through the roof. So shorting is not something that you do flippantly, and it's not something you do without knowledge. Now, when it comes to stocks, or when it comes to Bitcoins, or when it comes to commodities, if you want to take I'd rather take a bearish position often than a short position. For example, if I were to buy calls, I have limited risk. So maybe a call right now, might cost me $20 to buy one contract on the volatility index, something like that, or whatever it costs, right? A net of $20 if I do a debit spread. Well, my risk is limited to what I bought, right? My risk is limited. If it doesn't work out, I can only lose that amount. So I really love the idea of using options. I can buy a put option like Mark Cuban did on Yahoo. That's much smarter than shorting it. Yahoo could have tripled and quadrupled in price. But if you buy a put option, you have fixed risk. If you short a stock, you have unlimited risk. So, when it comes to shorting, you want to look at all your options, literally look at options, no pun intended. You want to look at all the different ways that you can have a bearish position that might not be a short position. But you should know both. It's part of your financial education. And there's so many real estate investors that think they're buying real estate when they're actually shorting the dollar. Because if you're buying real estate with cash, then you're truly buying real estate. But if you're borrowing money to buy real estate, you're shorting the dollar because you're doing the 4 steps. Follow it through the incomes, follow it through your financial statement. What happens first? The first number goes in the what? The liability column. The second number goes in the asset column, the house. The third number goes in the income column, the rent. And the fourth number goes in the expense column, returning back what you borrowed. That's the 4 steps. You are in a short position. You can track the money that way. Now, if a person doesn't borrow and they buy their real estate with cash, they're buying real estate. Okay, they're buying real estate. But if a person borrows money to buy real estate, they're shorting the US dollar. That is what they're doing. And they're betting on inflation. If you have deflation and you have a fixed payment, you can be underwater if the dollar strengthens and the rents fall below your commitment of that payment. And there's your risk. And now you feel the short position. You feel the risk of that short position being brought to bear because you have an obligation to pay back. And that emphasizes the short position that you're in if the dollar were to strengthen. So, we had a discussion on financial statements and understanding the sovereign level of this stuff. Real estate investors, they got to know this stuff so they can have confidence. I have total confidence the dollar will fall. I don't see how the policies and the fiscal irresponsibility of the United States can send it any other way. So I would borrow as much as I can, as fast as I could, and get as much real estate as I could. That's what I would do. But people have to make their own decisions. Short the dollar. That's what I would do.
Yeah, I want to bring it back to something you said earlier, and you were talking about Mark Cuban and also how investors, they need to know this stuff. I don't think a lot of investors or the average person out there realizes that you can make money when stocks go up, when they go down, when they go sideways. Most people believe you only make money when the stocks go up, right? Now, going back to Mark Cuban, which is such a great real world scenario, maybe at scale, it's a little bit more than the average bear, but can you tell us the importance of that story of Mark Cuban? A lot of people don't know how that wealth was made.
Yeah, that was not, a lot of people think he shorted the market, and he didn't. He didn't short it at all. He was bearish. And that's why we started at the top of the show discussing the difference between being bearish and being short. They're not always the same thing. So real quickly, it's a great hedging story, really. It's more of an insurance story than a shorting story, but he did very well. So Mark, I don't know Mark. I'd love to meet him someday. I think he's fantastic. I think he's great. He starts off as a bartender. He's got the gift of gabs, gets into technology, eventually starts a company called broadcast.com with a bunch of buddies. They're all, zillionaires on paper. He's got about $300 million in the bank at this point. He's got this cool internet company that broadcasts, sports events around the world. Yahoo, before Google took him out, Yahoo was the premier search engine for a long, long time. If you remember in the 90s, it was kind of the place you went. And Yahoo decides to buy his company, not for cash, but for stock. They could issue stock and pick up this company. So I think I want to say it was 5.7 billion. I think it was.
Something like that.
Yeah, like $5.7 billion in stocks. So here now he's got 300 million in the bank, and he's got 5.7 billion in stock. And he's afraid, I don't know if it always looks great in hindsight. like if your house burned down tomorrow, Dell, and I said, did you have insurance? And you said yes. I'd say, oh, you're a genius. How'd you know your house was going to burn down? How'd you know to buy that insurance? Because so in hindsight, it looks great. I don't know how strongly felt, but if I had 5.7 billion of anything and I didn't insure it, I'm a moron. Could he have got cash? If he thought the stock was going to go down, why didn't he demand cash, right? Well, he's going to get more. Yahoo can afford to give him stock easier than they give him cash. They got the stock, they can issue it. So he spent all of his money. I think he spent all the millions that he had on insurance, and he bought put options, which gave him the right to sell at a certain price. The problem he had, I think he had a 6-month vesting period where he couldn't sell a stock for 6 months. I think that was in the contract. They didn't want to, have him issue it and then sell it all off and
dump it out.
Company. So the first few months, he's dying, man. Every penny he had, he put into put options. And so that got him through the 6 months, and he lost all that money, just like you lose money buying insurance because the house didn't burn down. When you think about a bearish position on a house, a fire would be definitely bearish, and you'd want to have insurance to remedy that bearish crash of the car or the burning of the house. So then what he did is now he can sell the stock. So now that he could sell the stock, what he did is he sold out of the money call. He put a collar on it, basically. He sold out of the money calls, which said, I'll sell it if it goes up a little higher, but you got to pay me to do it. Took that money to fund his puts, and he basically collared the stock. So if it had gone up, great. He'd have sold the stock and been happy to go to cash. If it goes down, he has the right to sell the stock, and he goes to cash either way. So it was a brilliant play. In hindsight, it was even more brilliant, but it's a great way to just lock down and ensure that value of those stocks. And that collar trade is a great defensive strategy. It's not so much a way to make a ton, because really all he did was preserve his wealth. He didn't really make a lot of money. He preserved a lot. He might have had a few more puts than he needed, like in the Trading Places thing where Eddie Murphy breaks the vase and they insured it for more than it's worth. He could have done that. But it's a great opportunity for financial education. Bottom line, learn the difference between a bearish position and a short position, because they're not always the same. You can have a long position that is a bearish position, as Mark Cuban did. He was long put options. He purchased them, and he had a limited amount of money he could lose. He didn't have an infinite loss. If the stock would have soared, he would have lost his put premium. That's it. Learn the 4 steps of borrow, trade back, and return. And then you can analyze the positions you're in. A short position can be a cash flow position in the case of real estate, but it starts on the balance sheet, starts with borrowing money. So there you go. There's short positions. Great stuff, man, to learn it.
I absolutely agree. Well, guys, that's a wrap for today's episode of Rich Dad StockCast. We hope you found our discussion on short selling insightful and helpful and practical. And as always, a big thank you to Andy Tanner for sharing his expertise with us. Now, remember, whether you're just starting out or a seasoned investor, staying informed and educated is the key to success. Now, for more resources to enhance your own financial knowledge, visit StockCastBonus.com. And if you've enjoyed today's episode, don't forget to like, subscribe, and leave a comment. Your feedback inspires us to bring you more of the best possible content that you want to hear. Now, share this podcast with your friends and family to help them make better financial decisions too. Thanks for tuning in to Rich Dad StockCast. Until next time, get smart, get invested, and take control of your financial future. I'm Denney, and we'll see you on the next episode.
This podcast is a presentation of Rich Dad Media Network.